Perfect. All right, looks like everybody's in here. Everybody's good. Jana, I'll give you a minute to do what you got to do. Now we'll get going. Welcome, 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 everybody. While we are taking care of the final steps, making sure that we're recording for you guys, making sure that we are live and ready to go. Couple quick announcements, real quick. Nothing really too major, but tomorrow is my birthday, and I have one request from you guys. I want everybody here to send me $5. No, I'm kidding. Seriously, really appreciate you guys. Love doing this. And for my birthday, I would love for you guys just to head over to the Event Hawk page and leave us a review. Tell us what you guys love about these webinars. That would really help my business. We're all business owners here, and I never really ask for reviews or anything. We do these kind of webinars all year round. But if you guys want to support Event Hawk, support all these webinars and help us do more free stuff, please take a moment today or tomorrow to head over to the Event Hawk Facebook page and leave a review. That would help us all a lot. And you can mention what you love most, what you want to see more of, what you who you like better, me or Jana. No, I'm kidding. Just something on there that would be really, really cool. Other thing is, I know we talked to you guys might have seen we're doing a master class soon about getting bigger bookings. So we're going to do a free webinar next week, Monday. Look out for that, about how to increase your average ticket in 2023. So look out for that. That should be dropping soon. With that said, Jana, are we good to go? Are we live and all that good stuff?
Yes, sir. I'm just sharing to the groups and we are all set.
Perfect. All right. Welcome, 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 everybody. Welcome to Party Rental Taxes 101. I'm Tariq, your host with Event Hawk. For those of you guys who don't know me, I own a party rental business out of Chicago, and I also work at Event Hawk, and where we help party rental businesses with marketing, websites, all that good stuff. Today, I am joined by the wonderful Jana Thompson. Jana, you want to go ahead and give a quick introduction for yourself?
Hey guys, I'm Jana from Florida. I've been in the industry for 13 years and I work for Event Hawk.
Awesome, awesome, awesome. And last, but definitely not, I can't talk today. Last but not least, we have Alicia Mannion joining us here. Super excited. We don't get to have too many guests that are ready to speak like this. So I'm super excited that I get a break today. You guys get a break from hearing me, and Alicia's going to be the start today. So Alicia, the floor is yours. You want to give a quick introduction of who you are, why you're here, and what you're going to talk about today.
Thank you. Hey guys, my name is Alicia. So I am the founder and owner of Commonwealth Accounting and Bookkeeping. It's based out of Kentucky, but I work throughout the United States. Last year, my husband and I bought a inflatable company out of the blue. So we got to meet Event Hawk at IAPA 22. They are so nice, amazing people. Also at IAPA, I got to meet a lot of people that was needing accounting, bookkeeping, tax help. Hopefully some of you are on here. And I think that's definitely a need. Sorry, I'm scrolling through people's videos because I like to see your faces. I definitely think that's a need in this industry. So Tariq made some awesome posts in the group a couple weeks ago. You all asked questions on it. We pulled those questions and I'm going to try to answer your questions. If you have any other questions while I'm talking or afterwards when we open the floor, feel free to comment in the message board. I am going to put my email and my phone number in the chat. And throughout my little spiel, I'll say things that you can message me or email me. So I know what you're needing and you don't have to remember all of that the whole hour that we talk.
Beautiful. So you guys got that? While Alicia does that, we're gonna do what we do. So let's go ahead, and while she's doing that, let's do the thing that we do. Since you guys are all on here, everybody, we're gonna take a picture. So go ahead and turn on your cameras. I'll give you guys 10 seconds if you want to be in the picture, and then we'll take a screenshot and post it afterwards. We'll count to 3. We have 6 screens, so I don't know how many of you guys are gonna turn your cameras. We might have to take a couple pictures. So everybody camera on. I see some of you guys have your camera on, but you got a black thing on it, so I can't see you, but that's okay. All right, let's do it. On 3, everybody say cheese. 1, 2, 3, cheese. Boom, there's 1. We're gonna do one more for page 2. Wow, we got 2 full pages so far. Ready? On 3, 1, 2, 3. Beautiful. All right, and we got a page 3. Holy moly. All right, 1, 2, 3. Everybody say cheese. Wow, beautiful, beautiful, beautiful people. Awesome. Somebody said Event Hawk Accounting Services. I'll be pleased to share with you guys. We will not be selling anything today. You guys know I like to, teach you guys a bunch of stuff and then sell you something at the end. That's not happening today, so you guys don't have to worry about that. This is just Alicia coming here to share her expertise and experience. And if she is taking on clients, she'll share that with you guys as well on how to get in touch with her. So let's jump right in. We went through and looked at all the questions, compiled them, and decided that we'll kind of Janet and I will ask Alicia the questions, and she'll go ahead and answer them. You guys feel free to put your questions in the comments as well. There are a lot of people here, so if we don't get to your question right away, if we don't get to your question, or if you feel it's skipped, you may have to put it in a couple times. We'll do our best to keep up with everybody. So without further ado, let's go ahead. Alicia, we're going through your list, correct? The email?
Correct.
Let me find that real quick. A second. And while we do this, you guys are going to see a poll come up as well, asking you guys some questions that we are curious about, like to know from you. So feel free to participate in that.
While he's pulling it up, can you all write in the chat if you're using Excel for your bookkeeping, if you're using QBO for your bookkeeping, or if you're just not using anything?
All right, first question. Bookkeeping methods and tax prep. Why don't you tell us a little bit about the different bookkeeping methods and tax prep stuff out there? Okay.
I'm seeing a lot of QuickBooks in the chat, so that makes me happy. The 2 bookkeeping methods that I recommend that I help with is QuickBooks and Excel. So for a larger business, honestly, for a business that's doing more than 20 transactions a month, I would recommend using an accounting software. I recommend QBO or QuickBooks Online. It's extremely easy. It's on the cloud. You can access it from anywhere. How we do that is we use QuickBooks for our invoicing, our billing, our receipts. And then we use Google Drive, and we send contracts for a signature through Google Drive. All my onboarding questionnaire is through Google Drive, and we use Sheets for that. I don't know if you all are familiar with Google Drive. It's an amazing program. And then also with Google Drive is file sharing. The second method is Excel. And we actually used Excel in 22 for the inflatable business because we honestly were just kind of buying it for ourselves and didn't think we were going to do much of anything. That changed. So if you're small and you cannot afford any software, QuickBooks is $30 a month. You can find an accountant who can offer it cheaper. If you can spend $25 a month for QuickBooks, I highly recommend that. If you can find the discount. But if not, and you love Excel and you're good in Excel, the way that I would use that is by using paper contracts. I don't recommend, but if you use paper contracts, once they sign them, take a picture of the contract and put it in an iCloud folder album or a Google Drive folder. And then you file your contracts and keep them. If you use Excel, there's different tabs at the bottom, and you can keep up with your different lines of expenses that way. Your receipts is hard if you're not using QuickBooks. So when you have a receipt, I would write on it what it was for, and I would take a picture of it, save it in a photo album, and also file it so you have it. I do not recommend Excel. The old-fashioned filing system is what we call that. I don't recommend that at all. In QuickBooks, you can actually take a picture of a receipt with your phone, and it will put it on QuickBooks itself and attach it to that transaction. So then if you ever have to pull that receipt back up, you just go to your QuickBooks account, go to that expense, and then there's your photo of the receipt.
So just to clarify, Alicia, everything you're mentioning is to keep your finances in order for when it's time to do taxes, et cetera, things like that.
Correct.
Okay, so for the longest time, when I started, I wasn't keeping track of my finances at all, and tax time was a mess. Then we started using a spreadsheet to kind of just keep up. And then we started using QuickBooks, and that was good because it automatically pulled all of our transactions from our bank account. But then some of that stuff still didn't go in the right category. So eventually, as we grew, we hired an accountant who uses QuickBooks and also kind of does all that for us. When do you recommend, using a spreadsheet versus QuickBooks versus hiring an accountant?
If you use a spreadsheet, less than 20 transactions a month. You're still going to be in the spreadsheet for a while to enter those 20 transactions. But if you're needing to budget that's where I'd be less than 20 transactions. If you have more than 20 transactions, go and spend that $25 for QuickBooks and get a QuickBooks account. When to hire a bookkeeper or an accountant? When your time becomes more valuable than what you would spend to hire someone to do your books. Okay, so it could take you 5 hours to go in, run your monthly numbers, do a reconciliation, run reports, but it might take an accountant or a bookkeeper 2 hours to do it. And those 5 to 10 hours it's taken you, you could be out doing something else. You could be out marketing. You could be out actually doing drop off. You could be out cleaning. So I'm a very profit first preacher. So look at what your time is worth and when you would rather pay someone else to do it.
Okay, so I know this varies, but what can we expect an accountant to cost for somebody starting out? What's an average rate to pay an accountant?
Okay, so my lowest monthly fee is $250 a month. And that includes bank account, reconciliation, financial statements at the end of every month, and going over those financial statements with them, explaining the numbers, answering any questions they have.
Is that on the lower end, higher end, middle? What can we expect?
That's lower end.
Okay, gotcha. All right, awesome. So as far as setting up QuickBooks, we get QuickBooks. When I first started using QuickBooks, I linked it to my bank account and it automatically pulled in the transactions. Then what? I didn't know what to do. And eventually I'm like, I see all these bars and graphs and it all looks cool, but I don't know what any of it means. And at the end of the year, I would just, send it to my accountant and he's still like, well, a lot of this stuff isn't reconciliated or whatever. So what advice would you have to people who don't know how to set up QuickBooks or what would you do with that kind of situation?
There is amazing knowledge on YouTube for QuickBooks. If you're wanting to do this yourself, you can YouTube it. Honestly, the setup is the most important part. This is accountant talk, but you want your chart of accounts correct. You want your taxes correct. You want all that correct in your setup. I would advise anyone to reach out and have a QuickBooks Pro advisor set it up for you. They don't have to take over the monthly bookkeeping if you don't want them to, but let them help you set it up. And I do that, but there's also people online that do that as well. There could be someone local to you. That's just, I really recommend the setup because it would take me longer than an hour to explain a correct setup on a Zoom.
Got it. And a QuickBooks Pro Advisor, that's somebody you pay one time, they set up your QuickBooks, and it should pretty much be good from there.
Yeah, so it, as long as you are like, I'm certified, so I'm a QuickBooks Pro Advisor. We've had to take like extra training within QuickBooks. But if you just do like a setup, it would be a flat fee. They set it up and then you're good.
Got it. Awesome.
And I don't care to answer questions here and there, which I gave you all my email and my text. If you all have questions, feel free to email me or text me. It is tax season, so it might take me a couple of days to get back to you, but I will get back to you.
All right. And what's, I mean, before we'll circle back, but do you have a website or best place to contact you? Just so.
Yeah, so commonwealthaccounting.com. But my email is hello@commonwealthaccounting.com.
All right, let me just pull that up. commonwealthaccounting.com. You have the blue green logo. Here, let me share my screen real quick, make sure I'm not sending them to the wrong website. Would it be this one?
Yes.
Perfect. So I'm going to go ahead and put that in the chat. Website, and your email is hello@commonwealthaccounting.com. Go ahead and save it, guys. The chat is going to probably get buried in a bit, so go ahead and save that information. Double check my spelling as well. I'm sure you have your email in the website. Before we go on to the next question, I'm going to put out a poll, and we're curious to hear your answers. So I'm going to go ahead and launch that. If you pay attention to your screen, you're going to see some questions about how you have your business established. There's a quiz question, and then a couple questions about 1099, W-2, and LLC versus S Corp. So if you guys want to go ahead and participate in that so we can kind of see where everybody's at, that would be pretty cool. All right, next question, Alicia.
I did not get to touch on the tax prep. Do you want me to touch on that real quick?
Oh, yeah, go ahead, sure.
Okay. For someone asked about tax preparation, and honestly, it's going to be what your accountant and what your tax preparer wants. They would usually send you an organizer to fill out to send back to them. But some things that you can do to be prepared for that organizer is to categorize your expenses by your tax type. So if you're an LLC sole proprietorship, you would be filling out what's called a Schedule C. You can go to Google and Google Schedule C, and you can see the different expense categories for that tax type. If you're an S Corp, you would be an 1120S. You can go to Google 1120S form, and then it'll show you your expense categories for that tax type. Your tax preparer will love you if you do this that way. You also need a list of all your assets. So that's anything that lasts longer than a year, that's over $500. Think inflatable, trailer, truck, computer. You will need the date that you bought it, the date that you put it into service, the price you paid for it, and if it was sold, the date and price you sold it. So that's some things to get ready at the end of the year. Granted, we're trying to keep it all together throughout the year, but I know we all get really busy in the summer, so it hits hard come November and December.
Yeah, you're at that tax meeting and they're asking you, you know, when you bought it, who you bought, and you're like, what? I don't have all that.
Yes.
Oh yeah, definitely helps to prepare. And then if you're using QuickBooks or something like that, you don't really have to fumble with receipts or anything. Everything is in there, assuming that you set it up properly and all your bank accounts are linked, etc.
I'm actually reading the questions. You need to know if you sold an asset, and you need to know when you sold it, so they know if they need to half year it or whole year it. it goes into depreciation, but they just need to know how long you had it within that year.
It says, I thought assets per de minimis safe harbor were 2,500 or less, not 500 or less.
Yes, so that is going into depreciation and 179. We will get there. Right now, an asset is considered anything over $500. That doesn't mean that it has to be depreciated. There are other options such as that, but you still need to know all that asset information for it. It still has to be listed as an asset.
Can you repeat the list again? A couple people are wanting it repeated.
Okay, yes. So,
This is for assets, correct? Or
for assets, correct. Okay,
Right.
You'll need the date that you bought it, the date that you put it into service, the price you paid for it, and if you sold it in that year, the date and price you sold it for.
All right.
Great question, Jordan. So when we're talking about buying an asset, it does not matter if it was financed through a loan or a note. The day you bought it with that note is what you're going to go off of. That note or that loan is considered, it goes into your liabilities, but that asset is considered yours the day you buy it.
All right, should be good. And I'll just write this down. Okay, next question. And this is the big one here. Write-offs. What can we write off?
Okay, let me go. I want to show you all this video before we get into this, because I think it's hilarious. Let me share my screen. JC, the forms, if you're LLC sole prop, it would be a Schedule C. And if you're an S Corp, it would be an 1120S. Okay, I'm gonna quit looking at the questions.
While you
All right.
pull it up, what if a truck is in your personal name, but you're using it for the company?
Are you an LLC or are you an S Corp? Whoever asked that, because there's a difference.
Well, it's
If you're
also-
an LLC, if you're a sole prop LLC, that doesn't matter because you're going to take a percentage of it anyways. If you're an S Corp, you really need to put that in your business name.
Here we go. All right, Schitt's Creek fans, here we go. No audio on your end. Turn up the audio.
Oh,
no.
yes, sorry.
It's kind of hard to hear. Oh, it's just me. Here, let me try to share it. When I shared it earlier, you guys said you heard it okay. Let me try.
Yeah.
Take my notes here. All right.
What's this? Looks expensive.
This is some new bedding.
I can't see it.
Didn't I just
You can't see it?
tell you to?
Okay, hang on. Hang on. All right, how's that?
Okay.
Can we see it?
Yes.
And here,
What's this? Looks expensive.
This is some new bedding.
David, didn't I just tell you to save your money?
Yeah, I am testing this out for the stores, so work is paying for it.
Work is paying for your bedding?
I was gonna leave, but now I don't want to.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know, the write-off people. What, why are we having this conversation?
So if I need booze to get through my day, I can just write that off?
That's a stretch.
But the skincare products you got this morning, those are right off.
What skincare products? You purchase skincare products?
Okay, I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This, not a write-off.
Oh, well, the betting's non-refundable, so.
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is. It is. You can't just buy things for yourself and write them off.
Well, then I'll return some things. There's not enough space in here for the massage chair anyway.
I should get back to work, just in case any more of your packages arrive.
Oh,
What good explanation.
Okay, so the biggest takeaway up here is that a write-off. Can you hear me?
Yep, we hear you.
Okay, a write-off lowers your taxable income. There is some confusion. Sometimes people think a write-off actually lowers your tax liability. And though it does, it doesn't do that directly. So what you would have is you would have your gross receipts, then you would have your deductions. And you take those deductions away from your gross receipt to get your taxable income. And then that is the number that you use to determine your tax liability, such as 22%. You would take that number times 22% to find your tax liability. So just try to remember that, where it's only going to take a portion of your tax liability away if you spend that money. If you owe $3,000 and you go out and spend $3,000, it's not going to make that $3,000 go away. It's just going to lower that $3,000 tax liability. I see Tariq's face. Do you want me to put this in a spreadsheet to show it?
So wait on. If you're saying that I owe $3,000 in taxes, but I buy $3,000 worth of business inventory, office supplies, whatever, dollies, you're saying I still have to pay taxes? It doesn't wash each other out?
Correct.
Why not?
And I can show it in I can show it in Excel. Hold on.
Good.
So
I know all these answers, guys. I'm just pretending to be, just so I can
yeah,
help.
I know. And it's easier for it's easier for me to show it here,
Yeah, go ahead.
where people can understand it.
Share your screen. Go ahead.
Yeah. Do you see it?
Nope.
Share. Okay. So first,
Spreadsheet.
you have your gross receipts, and then you have your expenses, and then you'll have your taxable income. And then say you're at a 22% tax bracket. Okay. So gross receipts, let's just do $50,000. Expenses, 25. We're just gonna make this very simple. 25,000. So your taxable income is your gross receipts minus your expenses. So your taxable income is $25,000. So $25,000 times this 22%, you would owe $5,500 in taxes. Now, if you go back and add this in here, so instead, if you do 50,000, but you add that $5,500 that you did owe in taxes, your new taxable income is $19,500. which makes your tax liability $4,300. So that actually only changed your tax liability by $1,200.
Why did you add the taxes to the expenses?
To show how, like, if we use the $3,000, where even if you owe this to the IRS, right? These are your taxes owed. Some people might think that you can just go put that in your business instead of that it would make that wash, but it doesn't. And this shows that because I added that number back into the expenses.
Gotcha,
So
gotcha.
say I ran this in December and I saw that I was going to owe $5,500 at the end of the year. So I went and spent I spent that $5,500. Well, it only lowered my tax liability by $1,200.
Got it. Okay, so you owed $5,500 and you said, hey, I'm gonna go buy $5,500 worth of stuff so I don't have to pay any taxes. So your expenses went from 25K to 25,000 plus the 5,500, which is a 30,500. So even though you added that $5,500 to your expenses, it only reduced your taxes by the $1,200 or whatever. Okay, gotcha. That makes
Yes.
sense.
Yeah.
All right, I get it now. Anybody else need me to explain it?
So I have to spend more.
There you go.
22% was just the number. That's really going to change for your personal tax situation.
Yep, 100%.
It's a common number, so I just used it.
All right, I'm gonna go ahead and share the poll results. So we asked, how long has everybody here been in business? 46% of you guys on this webinar have been in business for less than 1 year. Interesting. 37% have been in business for 2 to 5 years, and 16% of you guys have been in business for over 5 years. Got a lot of newbies. You guys are in the right place. All right, we asked the quiz question. We'll circle back to the quiz question. We asked 100 of you guys, 100 people responded. Do you pay your workers 1099 or W-2? No surprise, 72% do 1099 and 28% do W-2. We're going to touch on that a little bit. 90% of people here are LLCs and 10% are S Corp. Not saying that's right or wrong, just sharing the results. All right, and we asked the quiz question. Does your business have to pay quarterly income tax, or can you just do it at the end of the year? 36% said yes, quarterly taxes are mandatory, and 64% said no, quarterly taxes are optional. And the answer is, go ahead, Alicia.
No, you do not have to pay them. Not everyone has to pay them. Okay, so yeah, the way that there are two different types of quarterly taxes. So you have your quarterly estimated income tax and you have your quarterly payroll tax. When most people ask this question, they're referring to the quarterly estimated income tax. This is not something that's usually known until you start a business and you start working in it, that quarterly estimated income taxes are not required until you meet a certain tax liability. So say at the end of 22 that you owe $200 to the IRS. You're not going to be required to pay in quarterly in 23. It always goes back to the previous year. But say in 22, you owed $2,000 to the IRS. Then you are required to pay quarterly income taxes. The line for that is $1,000. If you owe $1,000 or more at the end of your tax year to the IRS, now that's not combined federal and state, that's just federal. If it's 1,000 or more, you are required to pay quarterly taxes. And what happens if you don't is you get penalized and interest gets put on that the next year when you go and file and you say you haven't paid those quarterly taxes. The way quarterly taxes work is if you owed $2,000 for 22, you would take that tax liability, divide it by 4, so $500. Every quarter, you would pay in $500. So at the end of 23, you have your $2,000 paid. The reason they do this is the IRS assumes that your income, your expenses, your taxable income is going to be the same throughout the years. So they just want you to pay it up basically so you're not making interest on it and they can make interest on it. You can volunteer to pay quarterly taxes if you have less than that $1,000 tax liability. I do not recommend it though, because just put it in a savings account, a high yield savings account, make some interest off of it, and then pay it back at the end of the year.
Awesome.
So the next is quarterly payroll tax. I'll touch on this a little bit, but if you're running payroll, you probably have a payroll provider or a payroll service. They keep up with all these calculations. They keep up with your tax liability, and more than likely they're filing your form and paying for it as well.
So to recap, it always goes a year back. A couple people are confused, so I'll just kind of summarize.
Okay.
Right. So should you pay quarterly taxes every, what is it, 3 months, or should you pay it all at the end of the year? It's based on last year's taxes. So the number is $1,000 if in 2022, for example, which we're filing taxes now, if you owed $1,000 or more in taxes, right? If you got a refund, then this doesn't apply. If you paid less than $1,000 in taxes, this doesn't apply. But once you, as of now, the law is if you have to pay, if you pay more than $1,000 in taxes for the previous year, then you are now obligated to make quarterly tax payments, and you just take the amount of tax that you paid last year and you divide it by 4, and you pay quarterly tax payments. Did I get that right?
That's correct.
And if you paid
States
less
are
than
different.
each state is different. Oh, this is for federal.
Yep.
Right? This is federal. Yep. Okay. Yep. And everything we're talking about, each state is different. So if you paid less than $1,000, then you could just pay at the end of the year.
That's correct.
And sorry, Alicia, I know I skipped to this question. Someone said, is there a tax bracket you should stay at for net income every year, like as the years go on?
You can hire a tax strategist for that, because that is a few hours that they will have to come through your financials.
Let's see here. Sales tax. I don't think we touched on that.
So that's all state. So
State.
that's going to depend on your state, the frequency that they want to pay. Each state has a different amount that you're going to have to pay, either yearly, quarterly, monthly, or weekly. Every state is different, so I can't really go through all 50 states, but definitely contact your Department of Revenue. They should have it on their website. If you can't find it on their website, they're usually really good at answering the phone call and answering any questions you have.
Awesome. And someone said, if you're a W-2 employee and you pay more than $1,000, do you have to pay quarterly? I think this is just for business you're talking about, right?
No, for if you're an individual and you owe, if your tax liability is more, okay. So as a LLC sole prop, your income would.
You're paying every 2 weeks anyways, if you're a W-2 employee. So I don't think,
Right, but they can still have a tax liability if they don't pay incorrectly, or if they're a W-2 and they have a business on their tax return.
Okay, so you're saying make extra payments.
Yeah, so anyone who, okay, so we're just sole prop and S Corp in here, correct? LLC and S Corp.
That's what we asked.
Okay, I probably should have started with this. Your business does not pay taxes. Your business tax return does not have a tax liability on it. Your income flows to your personal return. And on your personal return is where your tax liability comes into play. So when you get your quarterly estimated tax, they're going to say your personal name on it. They will not say your business name on it. Because as a sole proprietor, And as an S corp, you're not taxed as like a corporation. A C corp is taxed. All of that is flowing to your personal return.
Joint LLC is the same or no?
Partnerships are completely different. No, partnerships will give you what's called a K1, and it will flow to your personal return as well. So partnerships don't owe tax either.
Got it. This is a good question. What if somebody doesn't want to give you their social security number for like a 1099? How do you handle that?
Then you don't work on. You should be getting a W-9 or a W-4 before the person works for you. Because there's nothing you can do if they don't give it to you.
So if you already, and I assume that's what the question is. I was actually, my wife was just fumbling for one of our W-9s for our employees. She was looking for it. But if they, you know, you find it or you lose it or you forgot to ask for it, you just have to eat
there's
that.
really nothing you can do. You can't make them give it to you because you as the business owner is responsible for getting that and keeping it,
Got it.
unfortunately.
All right, so next question on this list here. I know we jumped around a little bit. Do you want to touch on anything else as far as write-offs, or do we want to jump on to using credit cards to track tax write-offs?
What was the first one?
Write-offs. Anything else that we didn't cover? I know we jumped.
So the biggest thing is I'm not going to go into like exactly everything that you can write off. Tariq was saying they'll ask about tarps, they'll ask about extension cords. I have you ask yourself, when you check out at the line or when you check out online, can I use this in my business? And if that answer is yes, then you save the receipt and you write on this receipt what you would use it for. Example, I have an office. So when I go and buy Christmas decorations, I ask myself, can I use this in my office? Yes, I can, because I'm going to decorate for Christmas. I buy it, I save the receipt, I put it in my expense. For crazy jumpers, if you're buying, the big ones are all the equipment, the tarps, extension cords, shelving. If you're using like a garage, boxes, you have to have an office. So all the papers, all the pens, all your laptops, all your tablets, all of that stuff, if it can be used in a business setting, claim it as an expense. Your bank statement cannot replace your receipt. You will need receipts.
Really? You have to have paper receipts?
Well, a picture of them. You have to have a receipt showing the date and the item on it and the price.
Man, I'm screwed. That's scary. What was the point of QuickBooks and all that?
That's what you still have to keep your papers. So QuickBooks is a way to organize all that. But if you get audited, you still have to be able to show. So like say you went to Walmart, you spent $100 and you get audited, they don't know what you spent that $100 on. So you'll have to provide a receipt to show like, oh, I spent it on tarps.
Wow. So you actually, like your clients actually have that shoebox full of receipts. That's like a real thing in 2023.
Yeah, those aren't, yes. But most of my clients use QuickBooks receipt capture. So they get a receipt, they take a picture of it, and then they throw it away, and then it's on their QuickBooks forever.
Okay, gotcha.
If you're not doing that, you should do that, because I know you have QuickBooks.
Of course I do. Of course. What do you mean? Nobody, this is recorded. So of course I have all that. All right. Let's go into what about food and employees and like things like that, as far as buying food for employees, maybe taking them out for lunch, or I guess your fridge. I don't know what other examples. Jana, you might have some more examples on this. Travel, that kind of stuff.
Yeah, so that's a great question. In the past 2 years, the meals have all been 100% deductible. They're going back to what they used to be. There's a 50%, an 80%, and 100%. I'm not going to go super into depth about all the different categories of them. There's what's called like a busy day meal, which is just like you're too busy to go home and fix lunch for yourself. So you're going to stop and get something to eat. There's client meals where maybe, I don't know why you would eat with a customer, but maybe you're eating with a customer. I mean, Tariq, you would, I don't know, as a like party rental, we're not gonna go out to people's houses and take them with us to get lunch. But that's another one. If you're meeting with like your accountant, if you're meeting with your lawyer, if you're meeting with anyone who has to do with your business, that's a meeting meal. And then if you take your employees out and feed your employees on like a work day, that's also, I would list that as like an employee meal. And then when you go and file taxes, your tax preparer, your accountant will know where those meals go in that percentage.
Got it.
Because they all can only claim a certain percentage.
And snacks and all that, if you have like a fridge in your warehouse.
Yeah.
Schools, all that.
Yeah, I would just claim that as an office expense.
Oh, okay. Fuel is, what can you tell us about fuel?
Okay, we're getting into,
Advanced?
sorry guys, I got my notes. Huh?
Somebody asked about fuel. We can circle back to
Alright.
it as far as write-offs.
No,
the next-
that's good. So with your vehicle, we can talk about that. With your vehicle, you can claim two different ways. You can have mileage or you can have actual expenses. You cannot do both. So with mileage, you get to claim mileage, which is how many miles you drive back and forth from your warehouse or your shop to set up, come back. Basically, it would be your trip times 4 because you're going to set up and then come back, and then you're going to take down and come back. And with mileage, you get to claim tolls, if you have any tolls, and parking. That's all you get to claim with mileage, because the mileage rate already includes depreciation and your cost of maintenance and fuel. If you do actual expenses, you get to depreciate your vehicle, you get to claim fuel, you get to claim new tires, you get to claim a new radio, anything that has to do with that vehicle, repairs, maintenance. I will say majority of the time, your mileage is going to get you more of a deduction than your actual expenses. So you can, I would recommend the first year you keep up with both. Have your accountant tax preparer compare the two and see which one's better for you. In the Crazy Jumpers, which is our party rental company, in that business, mileage is best for us. So I think that would probably be the same way industry wide, just because we get a lot of miles.
Can mileage,
So
actual cost be changed? Can you do 1 year mileage, 1 year fuel?
yes, and I want to say this correctly. If you choose mileage, you can change over to cost. But if you start with cost, you cannot change over to mileage.
The following year, you can't. You're stuck
No.
with fuel.
No, when you choose cost, you're stuck with cost.
Huh.
So you would have to sell that vehicle, get a whole nother vehicle to start mileage.
So it's per vehicle. So you can have some vehicles cost, some vehicles fuel or mileage?
Yeah,
Interesting.
unless you're running a fleet of like 100 or more vehicles, which I don't think anyone here is. So, but yes, your vehicles can be, you can do 1 vehicle mileage, 1 cost. A great way to track your mileage, QuickBooks has a mileage tracker. I'm sure there's other trackers out there. I just use QuickBooks. They have an app where you get in your vehicle, you press start, you do your route, you come back to the warehouse, you press end, and then it calculates all the miles that you drove for that day. It keeps up with it till the end of the year, and then you have your total miles.
Alicia, be honest. You do this every single time?
Well, if for my accounting business, yes, but if you remember me saying, I thought Crazy Jumpers was going to be very small. So you should see my Excel sheet of mileage that I had to add by hand. It was awful. I will not be doing that in 23.
I would hate to work for you, man. I've had to, your workers are probably like, oh man, we work for an accountant. Document
Yeah,
everything.
so you can, I think it took me about 4 hours to do the whole year, in 22. But that's just not something I want to do. I'd rather do my tracking app,
Got it.
which I don't know. In IO, do they show mileage? Like when you do the route planner, IO does?
Yeah, they do.
Yeah, so you could just take the mileage from that if you don't remember to do the app.
Yeah, that's a good point. If you're, that obviously that's just, you have to, everything that's routed. If you didn't route something, then it won't be on there.
Right, if you use the routes.
All right. Using credit cards to track tax write-offs. How does that work?
Someone asked about this. I highly, highly recommend this. We do not use our debit cards at all. We only use credit cards. Get a credit card in your business's name. It's really not hard. I'm sure once you start a business, you will get tons of promotional for credit cards. Pick one that you like. I have some that I recommend. If you want to send me an email or text, like with credit card on it, I can send you some. But what we do is we have 3 different credit cards. One is for Commonwealth, one is for Crazy Jumpers, and then one we use personally. And that way, everything is on that one business. We're not mingling funds, even though they are credit cards, they're in that company's name. And so we're not mingling it with our personal income or expenses. And what happens is you're going to use all those points from that credit card and go on free trips or get cash back. Or if you want to use it in your business, use it as a pay with points type deal. So I recommend that little financial bit. I recommend that to anyone that's able to get a credit card to use them instead. Now, you do pay it off at the end of the month. Let me go on. You do pay it off at the end of the month, just like as it was coming out of your debit card. Don't leave it there and grow interest. So don't spend the money unless you have the money.
What about, someone asked about fuel only credit cards. Should we have a separate credit card just for fuel?
I don't. If you are using a lot of fuel and your driver is going to remember to use that credit card, or you're going to remember to use a credit card, that is a fuel only credit card is good to use. It's just not something that we use. We're big travelers, so we use travel cards. So it's really what you want. Do you want cash back? Do you want travel? Do you want like a cheaper gas? Do you want Amazon points that you can use to buy stuff on Amazon? It's all, you can really set up. There's cards out there for everyone.
Yeah, I'm with you. I use credit cards for, the same reason, but interest is a killer. So for us,
yes, don't leave a balance on it.
And there is an option in most of them where every month it'll automatically pay the statement balance, so you never pay interest. So that's what I do, because I screwed myself over with my Best Buy credit card once, forgot to pay, and then realized 3 months later I had a bunch of interest.
Oh no.
Big TVs, yeah, I forgot about it. I got the credit card, they got me in line. Hey, you want 20% off? Get our credit card. I'm like, sure. So yeah, statement balance definitely is a good auto thing where you automatically, never the minimum balance, the statement balance. Because somebody said, don't ever use credit cards, but yeah, if you pay them off, it's the same thing. It's just a different way of organizing it.
Correct.
Next
Don't do
question.
it unless you're disciplined enough to pay it off.
Gotta be disciplined. And if you're a business owner, then most of us should be disciplined, right?
Correct.
All right, writing off cell phones, internet, home office, vehicles, auto insurance, etc., all that good stuff.
Okay, so we talked about the vehicles. What I did not touch on was auto insurance. Same thing. If you do expenses, you can claim your auto insurance, but if you use mileage, you cannot claim your auto insurance. Cell phones, unless you have a cell phone, unless you have 2 cell phones, I should say, you would only claim a percentage of your cell phone. So if you have 1 cell phone, it is assumed that you use it for personal reasons as well, whether that's 20% personal, 50% personal. You have to come up with the percentage that you use it in your business. So say I have one cell phone, but 70% of my use is for a business, then I would claim 70% of the cost of it. If you have two cell phones, it's very reasonable that one of them would be your business phone and you would claim it 100%.
What about like we use IO phone, Event Hawk, kind of those are strictly for business. Would that count as just?
All of that would, yeah, that would be like softwares. Yeah, all of that would be deducted. As for home offices, the way that you find your home office percentage is you take the square foot of your office in your house and you divide that by the square footage of your home, and that gives you a percentage. Then you take all your home expenses and you would multiply it by that percentage. So say your percentage is 10%, like 10% of your house is home office. You would take your electric, your water, your internet, your lawn care, your maintenance. If someone came in and painted the whole house, all of that, 10% of that would be included in your home office and be deducted from your net income or gross income, sorry. If you do anything that is particularly in that room, so say your office, like you redone the floors and all of that cost was absorbed in that office, it wasn't anywhere out of the house, then you get to claim 100% of that. You just need to make sure that you have those separated as what was the whole house and what was just in your office.
What about if you store your inflatables in your garage?
Yes, so you would take you would add your garage square footage to your house to get a total. And then you would take that square footage of the garage and divide it by and divide them by the total. I see that.
Someone said, what if you clean your inflatables in your yard?
Okay, so a little tidbit of taxes I didn't think we were going to go into. Land is not tax deductible. Only structures on land. So that's really funny. I wish we could, but unfortunately not.
Way too hard at that. I think if I was drinking something.
I guess if you like set them up in your house, maybe.
All right, so structure. So land doesn't count if you have a 5,000 square foot land and 2,000 square foot house. It only counts for the 2,000 square foot house. If your garage and your office and all that stuff makes up about, let's say, 500 square foot out of the 2,000 square foot of the house, that's 25%. So you're saying that because the garage and the office make up 25% of your house, you can claim 25% of your house expenses, including internet, water bill, mortgage, all those things, because that's kind of there. Does that sound about right?
Mortgage interest, yes.
So mortgage interest, not mortgage?
No, so you don't claim your mortgage on your taxes, you claim your mortgage interest on your taxes.
That's right. Okay.
The interest that you pay on it, along with property taxes.
Water bill, yes, Abby, water bill
Yes.
counts. If you're an apartment, yes. If you have
If a rent, it's the percent of the rent.
oh, so you could claim rent, but not mortgage, a percentage of the rent.
Correct, because because a mortgage is like an asset, like that is your home, and rent, you're just paying someone and that money's gone.
Got it. What about detached pole barn? Does that count as a structure?
Okay, so it depends on how you want to do it. There's some ways that you can make it. Okay. You would include the square footage of that pole barn into your house. Same thing like attached garage is what you would do. Unless you wanted to sell that part of your land to your business and then include that as like a business building. But that's going a little bit deeper.
Man, might put up a tent outside and count that as a structure. No, that won't count. Does it matter if the utilities are in your personal name? They can't, obviously not going to be in your
No,
business.
because it's a home office. So
Yeah.
everything should be in your personal name.
Storage units, obviously that would be a straight expense, right? They'll just be rent.
Correct. Yeah, so home office is only in your house or in your personal area.
People are getting creative here. Renting to your business, renting your garage to your business, renting a part of your house to your business.
Someone's been watching TikTok.
Oh,
So yeah, so this is a thing. It is not always the best tax strategy. So I cannot, you can do that, but sometimes you owe way more in taxes whenever that happens. So I definitely talk to I'd actually get an accountant. I wouldn't just use a tax preparer for that. I would get an accountant and talk with them and see what the best way would go. Best way to do that is.
You're gonna have to pay taxes on the rent that you make, right?
Correct.
Oh, there you go. That's clever.
So now you don't only have to file a Schedule C or 1120 and then a K1, you now have to file a Schedule E for rental income as well. So it's really just pass through. Sometimes it helps, sometimes it doesn't. But that's really, someone said that's all over Instagram. Yeah, it's clickbait to get you to call them, and then they're going to tell you, well, you can do it, but that's really something that needs to be looked at individually.
I'm learning so much. This is awesome. All right. So we talked about cell phones, internet, home, vehicles, and auto insurance. Can you repeat what you said about auto insurance? You said if you do one, you could claim it. If not, and does the auto
If you
insurance?
do, yes, if you claim actual expenses for your vehicle, then you can claim auto insurance. But if you claim mileage, then you cannot. The only thing you can claim with mileage is tolls and parking.
So you're telling me that even if it's business auto insurance, I can't claim it if I do
Mileage.
If I do mileage, I cannot claim, even though it's not
You're not
personal.
supposed to. You are not supposed to. A lot of people do, but if you get audited, you cannot do that. Because that is supposed to be included in the rate that they give you for your mileage, that 62 cents, 0.5, whatever it is right now, that's included in that.
And that's why you're saying, mileage is usually better because it ends up being higher than your fuel.
Because they're including, so they're including, like, even though it sounds so small, like 0.625 for a mile, they're taking into depreciation, insurance, repairs, maintenance, fuel. They're taking all of that into consideration for each mile. And usually it winds up being more than what you actually spend.
So it's kind of like itemizing your deductions versus taking like a standard thing. So,
Yeah.
Okay. So the mileage rate kind of accounts for everything, or you can break it up, but you can't have both. Got it. All right.
Correct.
Moving on to the next question. And this is a big one here. W-2 versus 1099. This is
All
one
right.
where
What was the poll answers on this?
let's see. No
I forgot.
surprise. Out of 100 people, 72% said they do 1099 and 28% said they do W-2.
Okay, awesome. All right, I am going to pull up a little graphic. You all are welcome to take a picture of this for you all to reference later on.
We're going to talk about paying your children as 1099. That's on our list of questions. So we'll circle to that. Hang tight, guys.
Okay, so this is basically what you would ask yourself when you're deciding if you're going to pay a 1099 or if you're going to pay a W-2 for a person. I'm not going to read these to you. You can read them. You can take a picture of it. I am going to go through them and hit the high points. So a W-2 is someone who has work hours, who are expected to be at your office working from 8 to 5 or however long you want them to work. They are using your tools, your dolly. They are using your equipment, AKA your truck or your trailer. You have trained them into how to do their job. They're not a specialty in it. They're getting reimbursed for all their expenses, aka you're paying for their fuel, you're paying for their food when they're on the road. And it's something that they're working for you, and usually it's exclusively for you. They're not working for a bunch of other people in the industry. Most party rental employees are employees. They should be W-2 because we're telling them when to show up. We're giving them the route that they should take. They're driving our business vehicle. They're pulling our business trailer. They're using our business dolly. They're doing an employee's job. What a 1099 is and why they're not 1099s, or I should say how to justify that we use them as a 1099. So they're contracted for a certain project for a certain amount of time. So if you have someone and you say, hey, listen, I'm leaving for the next 2 weeks. Here's my rentals. You come up with the plan of the route. You come up with a truck and trailer. You come up with tools. I just want you to take my stuff and go and do it. Okay, maybe that's a 1099. They decide the route. They decide when they're going to start. They decide when they're going to end. They don't need training because they're the specialty in that. They understand what they need to do. They negotiate their own rate. They set their own pay. You don't hire them and tell them how much you're going to pay them. They come to you and they say, hey, this is how much I charge. Here's an invoice for my time. That is a big one. If you're going to 1099 someone, you need an invoice from them because it's not like an employee where you can just go by a timesheet. Usually a 1099 is going to work with other people in the industry. So if you have someone that maybe works for you, it works for another party rental company too, and just goes back and forth whenever work's needed, I could understand that being a 1099. But that when they're exclusively working for you, that's really hard to prove. This is extremely, extremely, extremely important because at the end of the year, when your contractor who you 1099 goes to file their taxes and they learn that they are going to have to pay self-employment tax on themselves and they're going to owe in a lot of money and they didn't know that they were supposed to save money for taxes, they will be mad. And their tax preparer or their accountant is going to ask them what they did. And if they can justify that they were a W-2 employee, they can send in a form with their tax return saying that they were a W-2 employee and why. The IRS will investigate. And if it comes back that they should have been W-2'd, then your company will owe the back taxes of your employer taxes plus penalties plus interest. So just, this is an important one of doing the right thing.
Is there a minimum that you have to make before you, for example, company, do you have to make over a certain amount before you can be scrutinized for this kind of stuff by the Department of Labor or something like that?
I mean, if they send in the form saying that they're W-2, they're going to investigate it no matter how much you make.
Okay.
Now, I don't want to talk about a gray area. As a 1099, if you do not W-2 them and you are 1099 them, you do not have to give them a 1099 unless they make over $600
Per year.
Yes, per year. That's all I can say about that on here.
Okay.
I can talk more if you off the Zoom. But also something that you need to think about too is your workers' comp can come back and audit you as well and see that these 1099s should have had workers' comp paid on them because Tariq's smiling because they were W-2 and now you owe workers' comp on them. Like it's crazy what can happen when someone wants to turn you in for not paying your employer taxes.
Couple questions are coming up with this about children, people under 16. You want to touch on that now or circle back to it in a bit?
No, we can talk about it now.
All right,
Okay.
so let's see here. Someone said, what about your children? What if they're under, what age do they have to be under, etc. And the question that came in on the post was, sorry, let me find it. Paying your children up to $12,000 a year versus 1099 and write off. Don't know what that means, but if you want to go ahead and go through that.
Yep. Okay. So there is another huge TikTok thing or social media thing going around is paying your child under 18 up to the standard deduction for that year. So like $12,650, I think is 22. That might be wrong, don't quote me, but around $12,000. This is a thing. It's very particular how you have to do this. You cannot 1099 your child. If you 1099 your child, they are going to have to pay self-employment tax. Okay. You would have to W-2 your child that $12,000 or lower, whatever you pay throughout the year. When you set up your child in your payroll system, you would mark them exempt. And so you wouldn't be paying what's called your FICA taxes on them, which is all your federal taxes. However, that is federally. So you can get away with not paying the federal taxes on your child if you W-2 them. However, you still have your state taxes, you still have your county taxes, and you still have your city taxes. So example, I'm in Kentucky. I'm not going to go through every state, but I'm going to go through Kentucky. So I still have to pay worker compensation on my child. I know there's some states where you have to have like 10 employees before you ever pay workers' comp, or you don't have to pay it if they're family. Kentucky is very strict on workers' comp. And if I have one employee, all of them has to be covered by workers' comp. In Kentucky, I don't have to pay unemployment on that child. So that is something that I'm saving. I don't know other states. We would have to look into that. There's a certain state that you were wanting to know about. And then you have to check in with your city and your county occupational tax as well. I don't know if you all are doing this, but you should be paying county and city tax. And most of them don't care if it's your kid and don't care how old they are, you would still be paying. So yes, you would save a substantial amount of money on those FICA taxes, and your child wouldn't have to pay those FICA taxes, but your business is still gonna possibly pay workers' comp, possibly pay Kentucky unemployment or state unemployment, whatever yours is, and possibly pay county and city occupational tax. Now, if you do this, there are some requirements that you have to meet to be able to claim this. And this is getting huge. This has been really big since COVID. And I can just see in about 5 years, everyone who filed exempt childs are going to get audited. So make sure that you have this ready. Your child must be a legitimate employee. Don't have a 4-year-old set up a bounce house. Okay. Your baby, I'm going to say toddlers to 8 years old. Those are going to be your models. Those are going to be the people in your pictures, in your videos that's on your website that you're posting on social media. That's going to be their job title. 8-year-old and up, they can be cleaning bounce houses. They can be cleaning the warehouse. They could maybe do some like data entry in Event Hawk or in the website. 12 and up, you could have them, going out to do setups and takedowns with you. Make sure in your state that the age is appropriate for the work you're doing, because some states are weird about that. But make sure that it makes sense. Don't say that your 4-year-old is setting up a bounce house, because we know it's not. but your 4-year-old can be bouncing on a bounce house and you take a video of it and you put it on your website and then you pay your child for modeling fees. The salary must be reasonable. You're not going to pay your 4-year-old, well, okay. Look at the salary, look at salaries in your area. Where I'm at, I'm in the country. Nobody's going to pay a child $60 an hour for modeling, maybe in a big city. Ours gets paid like $10 an hour for our modeling work that we do. Make sure it makes sense. You can't pay a child $50 an hour to clean bounce houses or to clean your shop. You know, look at $15 to $20 an hour for that. I would really, there are awesome resources online like payscale.com that you can put in your zip code and you can put in the job description that you're giving your child, and it will show you the median price that people in that area are getting paid. And I would go off that. You need legal requirements as an employer. Like everything that you get on all your other employees, you also need on your kid. So you need them to fill out a W-4. You need them to fill out a form I-9, which is just proving that they're a US citizen. And you need to get employment eligibility verification from them, a copy of their social security card and a copy of their ID if they have one. And you as a company must have an EIN. I'm assuming most of you have an EIN, but for those that are starting off and have only established with the state, you will need to establish federally and get your EIN. That's the legality of it. And then some other things that I would recommend just for you to have, I would have your child punch in a time clock, whether you're punching it in or if you have your employee, however you have your employees, keep up with their time. I would have your child do the exact same way. And your child also needs to be paid by check, not cash, by check at the same time that you pay your other employees. So say payrolls run on Friday, you're going to pay your child on Friday, just like every other employee.
Yeah, my kids will quit. I'm just saying.
Yeah.
I had a we had a guy quit, and you said you can't pay him $60 an hour. We had a guy quit, and my 10-year-old, she's like, Dad, he quit. I'm like, yeah, you know. She's like, well, how much were you paying him? I was like, we're paying him good. We're paying him $20 an hour. It's like, oh, no wonder he quit. You only paid him $20 an hour. It's like you can't buy anything. So yeah, I think kids are gonna have a higher minimum wage than adults these days.
For sure.
Okay. Yeah, that's I guess it's not as simple as TikTok and Instagram make it out to be. I want to go back real quick to clarify. You said if it's under $600, if they're 1099, you don't have to get 1099 them. But if they're an actual employee, do you still have to give them a W-2 if they're under $600?
That's correct. As I know someone said that their employer didn't. As a W-2, they are supposed to W-2 you no matter how much you make.
Interesting. Day labor, can you pay cash? Not familiar.
I recommend paying check. If you want to pay cash and not claim that as a deduction in your business, that's all you. And I know for some people that is easier because they can't find work. And so they have to kind of pay under the table is what that's called. But if you're wanting to be able to deduct it from your income, you're going to need to do it in a check.
Got it. Is there, so the ages, people are asking about ages, is that vary by state then? There's no federal regulation?
So federally, to exempt the FICA taxes, it's under 18. But there's some states that have like workers' rights rules where certain ages can't do certain jobs. And I just said, check with your state on those because I'm not familiar with every state.
This is a good question. Zelle, we use Zelle a lot. Is Zelle are we able to use Zelle for paying employees?
Yeah, so Zelle is actually a bank-to-bank app, unlike all the third-party processors. I love Zelle. It basically works just as a check.
Interesting. I thought it was only for personal. Is there something you can't use, or you don't like Venmo, Cash App, Zelle, all those are?
I
fine?
don't use, like, I don't pay anyone with third-party processors.
So
So
Zelle,
the Cash App, Venmo, Zelle is not a third-party processor. It goes from one bank to the other bank. There's no third party in it.
got it.
So it's literally like you're wiring, but it's free. It's like an ACH, but free.
Who owns Zelle then? Is it a bank? Is it one of the banks? Or
I'm
is it-
not sure because if you use a big bank, even my like small town banks, they have Zelle on like their website. Like I can go to my account and Zelle someone from my bank, like website.
It's got to be a third party company then, no?
Well, I think I'm not for sure, so I don't want to say guaranteed, but I think it was like a bunch of banks came together to start this, and then banks are joining in.
Got it.
But it's not, it won't go to, yeah, Zelle is like basically an ACH, but free. It won't go to a third party, like it wouldn't go to like Square or Venmo and then come back to the bank. It literally goes from one bank to the next bank.
Do you want to talk about donations?
We can. So the best, with donations, there is a limit to how much you can claim on your personal taxes. So if your business is sponsoring a nonprofit or a sports, whatever you're doing with it, I'm not going to talk about personal taxes here, but business wise, if your business is doing something to donate money and you're getting advertisement out of it, claim that cost as advertisement. So say I sponsor a ball team, but my logo goes on their back. I would claim that as advertising because I'm buying that logo basically on their shirt.
Interesting. So you're
Now,
saying that
there,
the cap for advertising is higher than donations, so anytime you can do
well,
that.
advertising goes on your business return. You don't claim charitable donations on your, as a sole proprietor, which is majority of people here, you don't claim that on your business return, your Schedule C, you claim that on your personal return, and there are limits to that, which I'm not going to go into. So if you want to claim it as a business expense, you would claim it as advertising.
Got it. Okay. So advertising, if you can, better than donations because there's, whatever limitations on it.
Correct.
Let's see here. Tax exempt. I don't think anybody's tax exempt, right? You'd have to be like a 501c.
Yeah. What was the question?
What items can you buy as tax exempt?
Anything that they're talking about sales tax, anything that you're reselling. So unless you're a reseller, that's not really, you're really not going to use that.
What about like
Yeah,
cotton candy floss?
I think it
okay, yeah.
depends.
So if you got supplies, if you're buying like concession supplies, or if you're selling, good catch, Tariq. If you're selling like party supplies, like tablecloths, napkins, all that stuff, you can be, whenever you buy that stuff, you can send in a resale certificate is what it's called. And then you won't pay sales tax on that, because when you sell it to your customer, you're charging them sales tax.
I think it depends on the state though, because when we buy like inflatables, we use our resale certificate, but then we have to pay tax. We have to pay personal tangible property tax on all of the things that we use like our resale certificate for. So it's just like a backward, like I would just prefer to pay it in the front end, but that's not an option.
Okay. All right. So that's definitely something that you should check with your state then. Sales tax is all state based.
So if it's your first year and you didn't make anything after expenses, you didn't net anything, how would you report that? It would just be a loss, right? How would you?
Yeah, it's just a loss, and some people worry about that. The IRS expects you to have a loss the first 5 years. So it's not really a red flag because you've got to invest money into it. When you do your return, you're just going to show a negative number, and you won't have to pay like taxes on that amount, obviously, because you don't have any income. But it's not something to freak out over either. They're not going to come after you because you have a loss.
You still have to file though. Don't think just because you have a loss, you don't have to file.
Yes,
tax.
you still have to file. Yes, you still have to file.
Now, if you set up a unit for free at a fundraiser for like a foundation or something, don't do that. But no, I'm kidding. If you do, a lot of us, when we start, we're ambitious. We do the exposure bucks. So instead of writing that off, let's say it's a $500 rental, instead of writing that off as a donation, you donated $500, you would do $500 in marketing. Would that work? Because you're putting your inflatable in the church property and.
Okay, so the way that donations like that work for businesses, you cannot claim your service. So say that your service was $500 to set up, you can't claim that. You can claim your cost of the service. So say you set up, it was worth $500 set up, and you paid someone $150 to operate it. The only thing that you can claim is that $150 because that was your cost of the setup. The best way to do this is to donate the money to whoever you want it to go to, have them come back and give you that money back to pay you. It's almost like a wash, but at least you're showing your charitable contributions that way.
So you're saying if I'm gonna set up at a give them a free rental and it's worth $500, you want me to donate $500 and give them the free bounce house and then have them use that $500 I paid them to pay me back?
If you're wanting it to show as a charitable contribution, yes.
But then I still
Because
can't that full $500. There's you get a percentage of that, right? Or whatever.
Well, the charitable contributions would go to your personal return again. So we're moving that way again. The best way to do it is if you're going to donate a product or a setup, put something with it that has you at cost, that you're out of cost with. So have an operator there. Pay for concessions, supplies. Buy something specific for that setup, whether it's like a board that has that name, like say it's like for a fall fest, like have your name and then the school name and fall fest. Have something at cost for that setup, because just going there and setting it up is not deductible.
Because it's a service, it's not an actual. Okay, got it.
It's not at cost, correct?
What about if you donate a gift, like a gift card to a PTA or a raffle or something, that you could deduct that $50 gift card 100%?
Yes, gifts, you can claim up to $75 per gift.
Okay, what would that go on? Would that go under just gifts? There's a line
Yeah.
item for that?
There's not a line item for that, but it would be an other.
I
I
mean,
want to,
this is, I know somebody that actually did this. Someone's asking about setting up a 501c. And they actually do that, and they kind of do, I don't know. I mean, what do you think about setting up a charitable contribution for your business?
like setting up as a nonprofit for your business.
Setting up a nonprofit business and playing that game.
Yeah, that we're not going to discuss that here.
All right, that's when we turn off the recording. Maybe.
Yes.
Right.
I do want to touch on this. Someone said, can you discuss sales tax? That they know it varies, but how our services are taxed? Because I saw someone in a group say that he charged like $1 for rentals, and then he charged like a crazy amount for delivery, and he only had to charge sales tax on that rental. Please, please, please check with your state. Kentucky, we have to charge sales tax on the service, on the rental, on the delivery, all of it. So I don't know who it was that said that. I don't know if he was joking, but just make sure you check with your state before you take anything offline that people say. Especially people that's trying to get around not paying tax.
Yeah, a lot of this stuff is state specific as well. Definitely a good point.
Yes. Yeah, so delivery fees like that would be state specific. Kentucky, we have to charge sales tax on delivery fees. Apparently the guy I saw on Facebook, he didn't. I don't know what state he was from. So that's something that we would have to check your state.
Got
Do you
it.
know yours, or do you have to pay sales tax on delivery?
I'm not sure. It's a good question. I'm making a list here.
No.
We'll have to talk afterwards. This is a good question. We get this every year, and my answer is no. Like, why are you emailing me? But W-9, if when do you need to have a company? Like, people reach out to us. I shouldn't even say this. Please don't do this. But they reach out to Event Hawk and like, I need a W-9 from you. Is that something that's needed from businesses? A lot of businesses come out and ask us for W-9s. Even for our rental company, they'd be like, hey, I need a W-9. What's the whole W-9 thing? When do you have to have another company fill out a W-9?
Unless they are a corporation like a C Corp, you need to get a W-9 from them showing on the W-9 that they are incorporated. So technically, yes, you should be like sending out W-9s if someone like asked you for one, because unless you're like a C Corp that they can go and see that you're incorporated, they need that on the W-9 to show the IRS whenever they get audited, say like, hey, here it is, I got it. He wasn't a single person. He wasn't a sole proprietorship. He was actually this.
Okay, so what's the purpose of the W-9? Can you explain that? Let's just kind of go back to the basics.
Yes, so basically a W-9 is to track money that flows from businesses to individuals or businesses to companies that are taxed as a pass-through, which are LLCs, S Corps, sole proprietorships. Basically, it's a way for the government to make sure that they get their piece of the pie. So whenever someone pays me that X amount of dollars, say they pay me $500, I could just not claim that income and the IRS would never know, or that company could 1099 me and then I would have to claim it because that 1099 went to the IRS.
Got it.
And then they make sure that they get their percentage from it. It's basically like a W-2, but in the business world.
But it's the same W-9 for everybody, right? Like, that's just what we do. We
Yeah.
just have, hey, whoever needs it, here you go. Okay.
Yes.
Got it.
Yep.
Let's see here. So I got a bunch of random questions here. I'm not really understanding some of these. Guys, this is being streamed live on Facebook right now. If you're live, this will be on YouTube eventually. You might be watching this on YouTube, but you can actually watch this on the Event Hawk Facebook page right now or tomorrow. It's being streamed live, so you can go back. So for those concerned about watching the replay, it's live right now.
Do we want to talk about LLC versus S Corp? I don't
Yes.
know if you all in the comments want to discuss that or not.
Yeah, I think that was the next question anyway. So LLC versus S Corp, pros and cons. When should we switch from an LLC to an S Corp?
Okay, I cannot tell you without looking at your personal tax situation when you should switch from one to the other. You will have other people on social media tell you $50,000 in grocery receipts, tell you $100,000 in grocery receipts. I'm not going to tell you an amount because I like to be able to look at your personal finances and tell you which one actually is better, where that point is. I am going to share a couple graphics to talk about the differences in them. So this is the first one. And to understand this, you need to understand that an LLC is a business entity type and an S Corp is a tax election. So you can be an LLC and still be taxed as an S Corp. Okay. So an LLC is an instant setup. It's very easy to set up, just a couple days. An S Corp is harder to set up. You will need to include an accountant and you will need to include a lawyer because there's a lot of legality paperwork that has to be done, not to send in. It's a one form to send in to the IRS to become an S Corp, but you need a lot of paperwork for your documentation. You will have officers, not members, compared to an LLC. So you have to have like your board meetings every year. You would have to have like board meeting minutes. We can talk more into that for people who want to become an S Corp, but it does have more of a cost to set up. An LLC is low maintenance. Everything basically, you don't need to be going back and forth between your personal and your business bank accounts or like money, but it's not a big deal if you move money from one bank account to the other bank account as like owner draws. And I think someone said that in the comments. An S Corp is more maintenance and you're going to have a higher admin cost. You're going to have to run payroll. So you're going to have a payroll provider cost, software cost. You're going to have pay FICA taxes. LLC, you don't have to have payroll, but you can if you have employees. What makes an LLC a little bit better than an S Corp is that, or a little bit worse than an S Corp, is that your full income from the LLC. So you have your gross income, you have your deductions, and then you have your net income, your taxable income. That full amount is taxed as self-employment. And an S Corp, only part of that is taxed as self-employment. And that would be considered your salary, which we're going to go more into in a different slide. But the rest of that is taxed as capital, which is a way lower tax rate. In an LLC, you can transfer property between member and business and it has no tax liability. You're literally just moving it back and forth. And like, I want to put my vehicle in my business name, that's fine. I'll put in my business names. Oh, well, I want to bring it back to me. Cool. Let me put into my name back on it. There's no tax on that. However, if you transfer property in an S Corp between officer and business, that would be a taxable transaction and you would owe tax on those sales that's happening back and forth. An S Corp is more of an established business. You need someone in the office doing office work. You would really need to keep up with your books. There's no waiting till the end of the year to do your bookkeeping. LLC, you can be more relaxed. You don't really have to have someone in the office all the time. You can kind of wait till the end of the year and put it all together in a shoebox. You can't shoebox an S Corp. So tax liability wise, I'm going to show you all a graphic on how these numbers work out. I don't know. Did that pull up the new graphic?
No, it's the same one.
Okay. Share. Okay. So you have your profit at the top. This is your gross, your revenue. So it's both the same, $150,000. Owner wages, which is payroll, the LLC, you don't have to have payroll in it. So it would be $0 for the owner. And the S Corp, say your salary is $50,000 as an officer. So this $50,000 is what like FICA taxes, unemployment, workers' comp, all of that is going to be owed on this. This is the self-employment tax and the payroll taxes, basically what I just said. All $150,000 in an LLC is going to have this. Only that $50,000, that salary, is going to have this amount of tax on it.
But then you have
So-
to file taxes like separately for the business, no?
Correct. So that's where the admin costs become higher. But as an S corp, remember, as an S corp, you don't owe taxes on that business. You get what's called a K1, and that flows to your personal return. So I'm getting there, just hold on.
Yeah.
So total tax is you have 150,000. You don't have any owner wages. You're subject to this amount of 150,000 at 15.3%. So your total tax is $2,300. Because all of this passes through, all $150,000 flows from your Schedule C, from your Schedule C, which is your sole proprietorship form, to your personal return. Now, as an S corp, you will have to file a separate return, an 1120S. You have your profit. You have your owner's wages is 50,000. Only $50,000 has this 15.3% on it. So you only owe $76,050 on that tax compared to the 23,000. So $1,000, because you do 150 profit minus the owner's wages, which is 50. So you have a profit of $100,000. That $100,000 becomes known, that's your pass-through profit. So that will be taxed as a capital tax, which is lower than your payroll tax. These are usually 10 to 12% is a capital tax. So you still have the 150,000, but you're only paying this 15.3% on 50,000, and then 10% on the other 100,000, compared to a sole proprietorship where you're paying 15.3% on the full 150,000.
So you're saying that ultimately you will pay less taxes if you're an S corp.
Yes,
it's-
when you get to that point, but finding that point, like if you have $25,000 profit, you're not gonna make, you'll actually be out a lot more money because of the cost of an S corp. So there's costs associated with S corps, as in like you're gonna need an accountant, you're gonna need a lawyer, you're gonna need the cost for payroll. You're going to need to file another tax return at the end of the year. So you really have to take those type of things into consideration.
So would you say 150,000 is kind of like when you should consider becoming an S corp?
No, earlier than that. But again, I don't want to give it a hard number. I know this is recorded. I don't want someone to come back and say like, oh, she said this. I tell people between 75 and 100,000 that you should definitely be going into an S corp. But that can change depending on your personal tax liability. Do you have another business? Do you have other investments? Do you have rental property? Like there's so much more that can go into that number. But if this is your only company and you don't have anything else, between, I would say about 75,000.
Now that also varies based on, I mean, so is this
Your
net?
expenses.
How about net?
Yes, so it's your expenses too. Like, do you have 75,000 gross, but you spent $75,000? Then no, you should not elect to be an S corp. That's why it's,
So
I
you're saying,
just don't like to say.
you're saying, so these numbers at the top here, so the numbers you're talking about as far as, you know, if you're over 75,000 or 100,000, you might want to think about being an S corp. That's not gross, because a lot of people here are making $200,000, $300,000, $400,000 per year, but they're netting a lot less. So you're talking about net when you're taking home like 100.
Yes.
Then you
Yes.
look into being an S corp. Okay, gotcha.
Yes.
So I don't see this on the list of questions here, but I'm curious. I know it was asked, and I don't know if there's a reason you don't want to touch on it, but paying yourself, disbursement versus W-2ing yourself versus 1099 yourself. You want to touch on that? I think that's.
Yes. Okay, so if you are an LLC and you're taxed as a sole proprietor, you have not done the S corp election, please do not W-2 yourself. Some people think that you have to W-2 yourself to be able to get a loan at the bank. I promise you, you do not. You will show your loan officer your Schedule C from your tax return, and they see that amount. All you're doing when you W-2 yourself as a sole proprietor is paying in employment taxes that you don't have to pay from your business, because your business has been paying those employer taxes, and then you're pulling it over to your personal return and paying self-employment tax on it as well. The only time you should be a W-2 is if you're an S corp or if you're a C corp. This is how I recommend people pay themselves in an LLC sole proprietorship. It's that the correct term of it is owner draws. And what you would do, what I recommend is coming up with a percentage that you feel comfortable taking out of your business, or just a percentage that you have to pay your bills. Say every month, I'm going to pay myself 25%. I think that's like the profit first method, is 25% of gross receipts. So every day, every first day of the month, I'm going to look at my month prior, and I'm going to move 25% of my gross to my personal bank account. If you're not to that point yet where you cannot pay yourself a certain percentage every month, and it's rocky, because I know a lot of people are seasonal, I would do how much you have to do to pay your bills, and say every month I need $1,000. So you pay yourself every month $1,000. You just pull that out of your LLC bank account and you put it into your personal bank account. And then you can reassess throughout the year and see, like, oh, well, I made a lot more money. I want to go on vacation. I'm going to actually pull out $2,000 this month type deal. It doesn't matter when you pull that money out in an LLC sole proprietorship tax wise, but financial wise and as a business consult, try to keep it steady. So your money's just, your cash flow is not crazy inside your business. If you're randomly pulling money out of your business all the time, your cash flow will be awful. So when you get to the point that you can, try to really come up with a schedule that you're able to pull that money out on the first of the month, on the 1st and the 15th. If you need weekly, just come up with a schedule so your cash flow stays steady within your business.
Doesn't matter how you do it. You said, like, can I just bank transfer? Do I have to do it a certain way to pay myself?
No, you can bank transfer. And something that I didn't touch on and no one's asked, but it's extremely important, is you all might have heard about piercing the veil of an LLC, and you might not have, because a lot of people don't talk about it. But as an LLC, what you're saying is that your business is separate from yourself, and that's why you have that extra liability. So if I take my business bank card and I go out and I make personal buys with it, like I go and pay my home electric with it, I go and pay my kids' karate lessons with it, that is what's called piercing the veil. And if you ever get sued, all they have to do is bring up those bank statements that show that you used your bank account as a personal bank account. So it's extremely important that you move that money. Don't carry on a bank card using it like it's your personal bank account. Take that money out, whether you write yourself a check, whether you use ACH, you use Zelle, you just call and tell them to move it. Move that bank account, move that money from your business bank account to your personal bank account, then pay all your bills from it, all your personal bills.
All right.
So you don't account for this when it's on your Schedule C, because your profit of an LLC sole proprietor is being the full amount you're paying self-employment tax on. So you don't have to include those owner draws because all of the profit is moving to your personal return anyways.
I have to agree with, I think it's Ganako was asking, talking about W-2. A few banks, when we first started our business, they wouldn't give us loans because we had, well, a lot of notes and stuff. We didn't have, we weren't able to show profit, and the business wasn't around for, I think it has to be like 2 years, et cetera.
Mhm.
It is harder, I felt, a while back to get a loan when we were, without a W-2, because I went from having a W-2 at a job to quitting my job and working for my business. And then, even though we were profitable, the banks did give us a hard time. What would you say to that?
I have not run across that like personally or with my clients. It might be because we provide a great profit and loss and balance sheet. We provide those financial statements that they need to be able to approve it. And if you're not able to, I don't know if you were able to provide that or not, but if you're not able to provide that, the financial statements that they need, they're not going to approve you.
Well, I mean, I guess the business would have to show a significant profit. Like, I could pay myself, let's say, 50K, but then the business lost, 50K, then that would be a problem probably with the loan, because even though I made 50K, the business is showing a loss. Is that?
Well, but if you made that, so those owner draws that you're pulling out, that's not deducting your income. That's not on your profit and loss at all. That's just money that you've pulled out of your bank account as an LLC sole proprietorship. So what an LLC sole prop is that money, that profit flows through to you, is a pass-through entity. So that money is going to you whether you pull it out of the bank or not. So you're not going to show that owner draw on your P&L.
Got it. So whether that money sat in the bank as, we didn't even spend it, you just kept it in the bank, or you moved it to your personal bank account, you're saying it wouldn't make a difference?
No, you're still going to pay self-employment tax on it.
Taxes. Okay. So if at the end of the year, I have $50,000 sitting in my bank account that I don't spend in my business bank account, or if I pay myself that $50,000 and I go spend it on vacation or whatever, buying a new car, either way, I'm going to pay, well, not the car depreciation yet, but either way, that 50,000, whether I let it sit in the bank or whether I pay myself and I go spend it on whatever, because I'm an LLC, I'm going to pay the same thing on that.
The sole prop, yes. If you're a sole prop. It is extremely important to remember though, that $50,000 is not what you're being taxed on. You're being taxed on your taxable income. Profit and cash flow are completely different. But yes, basically. Your net profit, your taxable income is going to be the same whether you pull money as owner draw out of the bank account or not.
So you don't technically have to pay yourself. I mean, if you just keep it there, somebody's asking that as well. You want to?
No, you can leave it in the business. Reinvest it.
Okay, so yeah, you don't have to report that, is what she's saying. Somebody just asked. It's gonna get taxed either way.
That's your income. Like when a loan officer looks at your tax return, they're gonna see your Schedule C and see how much your business made. And that's gonna be what's considered, like, that would be your owner draws and the profit from it.
It all counts.
Yeah. S Corp is completely different. And if there's S Corp here, people that want to go over that, we can, but I think it was a very low percentage that were S Corps.
All right, let's jump into the last question. I want to address, somebody asked a question a couple times in the chat. I think it was Sailfish Bounce. I don't want to, I asked you to ask the same question multiple times if we miss it. They said, how many years does your startup costs carry over? Is there such thing as startup costs, or is it just?
Yes, there is startup costs. And I want to say it's 5 years. And actually I can just check that really quick because I don't want to give the wrong answer. Okay. So they can be deducted over 15 years,
Oh, wow.
but you have to deduct them. Yeah, it's like almost like a depreciation method.
Got it. I think it was Catherine that asked. So there you go. There you go. You're welcome. Sorry, I know I've seen it a couple times. I don't want to forget about you. You do have
Okay, there
question
is a
on
couple,
S corp.
there's
You
a
wanna
couple
do
S corp.
S corp first, or do you want to do depreciation?
We'll go into S corp for this payroll real quick, since we're already talking about payroll.
Okay.
Okay, so for an S corp, you have your payroll, which is your salary as an owner. So this has to be a reasonable salary for the job you're doing. If you're what you have to give yourself a job title. So whether you're office manager, whether you're driver, whether you're helper, you have to have some type of job title, and you have to have a reasonable salary for that job. What I recommend, you go to payscale.com, you put in your zip code, you put in whatever job you're doing, and it'll show you a low, a median, and a high for salary for that job in your area. You want to pick the low number because you want your salary to be as low as possible, but you need to be able to prove that it's reasonable. Then you're going to print off that page and you're going to file it. So if you ever get audited and they say that that salary is too low, you're going to pull out that paper and you're going to say, on pay scale, this is what they told me. And then they're going to say, okay, cool, wonderful. Then with that salary, it's just like you're a W-2 employee. You're going to get a W-2 at the end of the year. You're going to be paid on your payroll date. How it works on your business return is that is actually taken off. That is included in your expenses, your wages. So your gross profit will be deducted your wages to get the net profit. Someone said the next thing that you're going to do once you have, yeah, someone said salary.com, Glassdoor, PayScale. There's all kinds on there. I just like PayScale. For payroll, you want your payroll to be as low as possible, but you're still going to pull money from the business. What those are called are officer distributions. It would be like a dividend, basically. It's like you're paying yourself a dividend from the company. That's not the correct word. A distribution is the correct word for an S corp. So what I recommend on this is that you do them quarterly. You're going to pay yourself 10% of profit quarterly from your S corp. So every quarter you sit down, you do your books, you made $50,000, you're going to pay yourself 10% of that, or whatever percentage that works for you. They have to be regular and scheduled. They cannot be like the owner draws in a sole proprietorship. They can't be random. They have to be scheduled and they have to be regular. So I don't like to do an actual amount because in the summer, you're going to make a lot of money. In the winter, you're not going to make any, some places. So I like to do a percentage so your cash flow stays steady. And then every month, every quarter, you're going to take out X percentage of your profit and you're going to bring that to you as a distribution. These distributions work the same way as owner draws do. So when you, at the end of your business return, when you have your gross sales, you have your expenses, including your owner wages, and then you have your net profit. In that net profit is including all of those distributions, because that net profit, that taxable income, is going to flow to you on a K-1 as distributions, whether you take it out of your bank account or not. And then you'll be taxed at that capital 10-12%.
Got all that?
It's so much.
This is a really good question that I don't think we went over. Investing back into your business. Great question, John and Ann. What's the best way to pay yourself back, to track that, record it when you put money into your business to buy some stuff?
If you're using QuickBooks, I would set up personal loan. Just name it personal loan. Make it a liability. when you put money into your business, you would put it under that liability. And then every week, every month, you pay yourself back just like you were the bank, and you can keep up with how much you owe there. Does that make sense? Is that what he's asking? I didn't see the question.
Yeah, so you're saying that, when you put money into the business, there's an option in QuickBooks called personal loan. I mean, how does that get filed, et cetera?
So if you're a sole proprietorship, that it's include like owner draws, owner investments, those are the same. It doesn't, I could go put $20,000 in my business. It's not going to go on my tax return because it's a pass-through entity. What QuickBooks does is it keeps up with that liability, and they would have to create a liability account called personal loan or personal note, whatever they wanted to note it. And that just keeps up with how much they've paid themselves back for their self. But
So I
within
wouldn't-
taxes, as
I wouldn't pay taxes on that amount that I load myself and pay myself back.
no, because it would just be like you went and put $1,000 in the bank account, and the next day you went and you pulled it right back out.
Got it. What about last year's taxes? How do you deduct that? The taxes that you paid last year? Is that
Like
something?
for sales tax, for income tax, for payroll tax, I need a little, they're
I'm
all
guessing-
different.
Guessing it's income tax, whatever you pay, at the end of the year.
Okay, so if you paid income tax last year and you itemized and included income tax in your itemization, then you could include it. But that doesn't lower, so that's like again, that's going into your personal return, not a business return. You cannot reduce your business taxable income by income tax that you paid, because that's flowing to your personal return, and you personally owe that money to the IRS or to the state. So it does not go on your business return.
That doesn't sound fair.
Well, why? They're saying you made $5, right? You made $5. We're gonna tax you $1 of it, so you have to pay us $1 for that. Why would you be able to include that dollar the next year when you made $5 more? You're just giving them their percentage of what you already made.
I guess I see. Okay.
Now, some states will let you itemize, will let you include like sales tax and stuff like that, but you have to itemize to do that.
Got it. All right, let's jump into depreciation. I know that can kind of be a big rabbit hole, but I'll kind of just turn it around to you. What can get depreciated, et cetera?
Okay.
So first of all, depreciation, you want to explain what that is versus actually writing something off?
Yeah,
Completely.
so we're going to talk about expensing an item or capitalizing an item, because those are the two words. Everyone just says depreciation, but it's actually expense or capitalize. So, when you expense an item, what you're doing is you're taking the full amount of that item and deducting it from your income in that year. These items are generally less than $500, and they have a short-term benefit, meaning that they only benefit you for a year or less. Think a coffee cup. I know a blower's usually last more than a year, but they're less than $500, so they're going to be expense. Extension cords, tarps, shelving units, if they're that cheap. All of the day-to-day things that we use. When you capitalize an item, you are including it as an asset. So fixed assets and intangible assets. These are generally more than $500, and they're expected to have long-term benefits, more than a year. So think your inflatables, your trucks, your trailers. I don't want to go too in-depth in this. I went way more in-depth in some other things that I plan on doing, so I don't want to keep confusing you all, but an inflatable, all your depreciable, all your capitalized assets, they are going to have what's called a useful life. And that's what the IRS states that how long they're good for, basically. So an inflatable's useful life is 5 years, which means that you're going to depreciate it over those 5 years. Vehicles over 6,000 pounds. Yes.
Sorry, the 5 years, like, is that just a number is that actual number that's out there?
Oh, yeah. No, that's by IRS. Yeah.
The IRS has a number, a lifetime value for inflatables.
Actually, yeah, they're bounce house inflatables, I think is how they're listed on the rig.
Man, they're gunning for us, huh? Interesting. I know.
Oh, I mean, you can find useful life for about any item that you want.
All right, good to know. I'm sorry, continue.
No, you're good. No, you're good. I just looked inflatables up because I knew people would have that question on inflatables.
So you're saying you would take the cost of the inflatable, let's say it's $1,000, and you would deduct a fifth of that every year, divided by 5, and every year you would deduct, so like $200 a year. Is that so?
There is different ways to depreciate items. That is called the straight line method. You also have a marks method, MARCS. You all do not need to know this, but basically it has different percentages for each year that equal that 100% at year 5, but it's not a straight line. So that depends on what you and your tax preparer decide to do on that.
Got it.
Yeah. So some people are asking about inflatables before I move on.
Oh yeah, the questions are never going to end on that.
Okay, so if you sell an inflatable and it's on your asset list, then when you go to your tax preparer or accountant to file taxes, you need to take them that list that I gave you earlier, the date you sold it, the amount, and the amount you sold it for. And the software is going to do all the math, because I'm not going to tell you the formulas. Software is going to do all the math to decide what depreciation you have to recapture, because that's a huge formula. So someone wanted to talk about 179, which they use big words with it, but we're just going to say 179. Vehicles over 6,000 pounds that are bought and put into service. That's extremely important. Bought and put into service in the same year can be 179. That means that the full value of that vehicle can be used to reduce your taxable income. So you can use 100% of it.
If you bought it and sold it,
what's that?
That if you bought it and sold it in the same year,
then it's a wash.
Oh, I'm sorry. I thought that's what you said. If it was bought and sold in the same year.
Oh no, bought and put into service. So you can, majority of the time, you are going to buy a vehicle and put into service in the same year. But say you have a personal vehicle that you bought that you haven't used in your business yet, and you didn't put it on your business return, and then the next year you put it into service, you wouldn't be able to 179 it then, because it was technically bought in 21 but put into service in 22.
Somebody did ask, if you buy something in your personal name but you use it for business, is that a problem? If you buy a truck,
you can do that if you're a sole proprietorship. I do not recommend it if you're an S corp.
Got it. Is there, does the weight matter on anything? Someone's asking if it's under 6,000
yes,
pounds.
the vehicles have to be over 6,000 pounds. If they're just under 6,000 pounds, they don't count. They have to be over 6,000 pounds.
Interesting.
The IRS actually has a list of vehicles over 6,000 pounds that you can go and look at to see which vehicle you need to buy if you need to do that. Also in 22, they have raised bonus depreciation. So for equipment, you can take 100% bonus depreciation, which is basically like the 179, but it's a different name because it's not a vehicle. But they have to do the same thing. The equipment has to be bought and it has to be put into service in the same year. There is a max for this bonus depreciation. It's $2,700,000 is all you can claim in bonus depreciation. This is, I don't want to go too much into depreciation because everyone wants to depreciate all they can. Let's get it all in 1 year. That is not the best advice because we hope next year you're making way more profit and your expenses have lowered. And now you're going to owe a ton of taxes next year because we took all of your assets this year. So you really need to sit down with, if you have items you're depreciating, you need to sit down with an accountant and talk to them and see what your best bet is on how to do it. Majority of the time, I do not 179 vehicles because
Clarify what 179 means. Does that mean just writing it off in
just
1
write
year?
the whole thing off. Correct.
I knew that.
But
guys.
but if you take $60,000, or if you take $50,000 vehicle and you write it off for 2020, then next year your income is way higher. You're missing out on $10,000 worth of deductions because you took it in 22 instead of 23.
Buy another truck.
Yes, buy another truck. But that is something that Tariq is saying. If you're gonna get into that type of what's called tax planning, tax strategy, you need to talk to an accountant on that because that's not something that it took 8 years to learn. It's not something that I would be able to teach over a Zoom in a couple hours. Unfortunately, I wish I could.
April has a good question, and I did hear this. The whole 179, they're writing off all in 1 year. Is that new? I know there was a limited time to where you can just write off the whole vehicle in 1 year. Is that going to expire?
Yes. Yes, that is expiring.
So it was 22 the last year. So this is it. You can't starting 2023.
As of right now, that
Okay.
I'm going to say this. The regs are constantly changing. They could say this today and then in 2 months say that it's going to go on for 5 more years. As of right now, that is how it is, but it could change. And if you're watching this in the future, make sure you go and look at the regs because it could be completely different.
So
I'm not recommending anything. I am recommending that you talk to an accountant on your tax situation for your business and see what they say.
What about trailers? You mentioned 6,000 pounds. What about trailers and stuff like that?
They have to be like vehicles that you drive on the road, and unfortunately you can't drive a trailer on the road by itself. But a trailer would fall under equipment in 22 and that 100% bonus depreciation.
Okay, so you could just write it off completely.
Yeah.
Got it.
For 22. Now the 100% bonus depreciation is ending in 22 and I don't see it coming back.
Got it. All right. Anything else on depreciation?
If it's under 6,000,
from what I understand, if it's under 6,000 pounds, you can't use it for work. Is that like you can't buy a Ferrari? That's kind of what they're trying to do. They don't want you to buy sports cars and say that's for work, right?
well, you can buy a vehicle under 6,000 pounds and depreciate it, but you can't buy a vehicle under 6,000 pounds and then 179 it and take that full cost in 1 year.
Okay, gotcha.
You can still depreciate it over the life. You just can't claim 100% of it in that first year.
So is there a limit to what kind of car you could buy for for like us? If I say I need a business car, can I buy whatever car I want?
You can buy whatever you want.
All right.
You have to, so the IRS statement is that anything you buy in your business has to be reasonable, necessary, and industry common. Okay, so think about these people that own like business planes and yachts and all that. they are able to claim that because other people in their tax bracket have those things, then use them in their businesses. Right? So if you go and buy a Ferrari, are you going to be able to show another bounce house owner who has a Ferrari? Are you going to be able to explain why you need that Ferrari in your business? That type of thing. I'm not saying you can't buy one. If you want to buy one, buy it. The chances of you being audited on that is very low, but that is wording in there. Reasonable, necessary, and industry common. So think about that.
After today, we're all buying Ferraris, so it'll be pretty common.
Yeah, if we all decide to do it, then they can't say anything.
Got it. All right, anything else on depreciation? All right, we're getting Corvettes instead.
Hey, I got them right down the road. The Corvette plant.
All right, let me,
I think that was.
it all. I know we went a while. Alicia, I'm sure you're tired. I know you're used to being up late tax season, but we don't want to keep you too much. Anything else you want to cover? Anything else you want to touch on?
I don't know if there's any like established businesses in here for 2020 and 2021, but I've actually just finished up my last ERTC client, which is earned retention tax credit. Basically free money that businesses got in 2020 and 2021 for having people on payroll. So if you had people on payroll in 2020 and 2021 and you have not got your ERTC credit, please reach out to me so we can get you that money. It's just sitting there waiting to come to you. And everyone else, I'm not very good at selling myself, but I'm trying to put in a bit here. We offer anything from accounting to bookkeeping, business consultations, payroll, and tax strategy. So if you have like a question, one or two here and there, please email me, text me, find me on Facebook. I answer questions all the time. But if you're looking for services, I'm also taking clients as well. So that might be a little slow here come tax time, but I will get to you. And if you need tax help now, just make sure that you put that in your initial email or your initial text so I can make sure that we get to you in a timely manner.
Perfect. And is the best way to contact you through the website? Is there like a contact form that would work?
There is, but honestly, like texting me or calling me, we're very personable in my office. Tariq's like, don't use your personal cell phone number. We're very personable. You can text and call me all the time. I'm always on my phone. So that's the best way to get a hold of me. If you want to, you're welcome to go to the contact me link in my website or just email the hello and we'll get back to you.
All right, I'll put that email in the chat right now. Everybody, big shout out to Alicia. If you guys appreciate this, if you guys learned a lot, give her a big emoji in the comments or a thank you, letting her know how much we appreciate everything she's done. You're a natural at this. You're gonna be taking my job.
Someone asked, and I will answer real quick. So for business taxes, if you're S Corp or a C Corp, your taxes are due March 15th. If you're just LLC sole prop, they're due with your personal return. So the only ones here, I think, are S Corp. So you're the only ones that have that March 15th due date.
All right, you got a few people already planning on emailing you guys. Or you.
Awesome. Thank you, guys.
Definitely. Again, we don't want to keep Alicia, but go ahead and shoot Alicia an email. I put it on Facebook and in the chat here. So go ahead and send her a message. And hey, maybe we'll do a part 2 if if you get a bunch of other questions that weren't covered. If you want to do that, or maybe make a post or something like that. We will. This is recorded. If you guys are watching this live, then it's on Facebook. If you're watching it on YouTube or elsewhere at another time, I'll put Alicia's contact information in the comments. If I forget, please ask, and I will include it later on. You guys are awesome. Enjoy the rest of your evening. Thank you again, Alicia. And I'll go ahead and end the broadcast now.
All right, bye, guys.